Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Joining us now, Christy Tan, APAC investment strategist at Franklin Templeton Institute. Christy, thank you for joining us. Well, this is a time where there's been so much focus on equity markets and the record highs we've seen in global markets and the AI theme that it's kind of stolen the thunder a little bit from bond markets. It's like the Fed and how many rate cuts this year used to be a daily discussion point, a little bit less so now. I'm curious how you're responding to this and what you think about the current economic backdrop in global markets.
Hi, good morning or good evening. We are definitely looking at, standing at the junction of pivots. And we're not just talking about one or two, but multiple pivots. And that's related to U.S. Fed, U.S. macro data, politics, China, and of course, Japan's progress beyond corporate reforms as well. So let me just get through this a little bit. So the Fed's just pivoted from 3 rate cuts to 1. And I think what investors should be looking at is beyond that. So beyond this year, and we're looking at the similar end game where the Fed is, the dot plot is suggesting a 3.1% Fed funds rate at the end of 2026. So this probably dovetails with the expectations that inflation will only taper towards 2% in 2026. And this, I think, is understandable. Then, the focus is probably more on the near-term events, and that is related to the U.S. elections that's upcoming. And then for the rest of the world, I think we do think that, China is currently taking steps to close the distance between investor confidence and also macro recovery. And the other thematic and hot topics that are definitely gaining quite a bit of traction with investors outside of the U.S. is also Japan, which is navigating the economy towards the positive real wages. And that is one of the conditions for the bullish prospects for Japanese equities to sustain. So in light of all this pivots, and we are right at the junction of this. You can, we would like to actually, look at investments that will deliver growth over value. And we are looking at also, I think, in the equity space, quality in terms of tech. Okay. So not just broad AI.
So, Christy,
quality.
you're normally based in Singapore, but I imagine you're in Tokyo talking to people. I'd like to get your view on what you're seeing in Japan. We just had the inflation data up 2.5% in core CPI. That was a little below the mark in terms of what the market was expecting. The equity market, we know, in Japan has been doing very, very well. I think the problem right now in terms of policy has been with the persistent weakness of the currency. Give me your assessment. What do you see when you travel around Tokyo and talk to people?
Yeah, so that's a great question because after talking to people in Japan, I think that the yen, of course, is one of the key talking points. And if you look at the relationship between dollar yen and the interest rate differentials with the U.S., we have already observed some narrowing of these interest rate differentials, given that Japan's exited the negative interest rate policy. So going forward, we do see that the prospect of the Japanese yen to strengthen has actually grown. And the yen is significantly undervalued relative to history. And one of the key drivers will probably be the upward momentum in the Japanese equities and also continued inflows. Now,
Well,
if
and
the
maybe
CPI
also if the BOJ takes another step in normalizing. This reading that we got on inflation today, while it was a little under the estimate, was still pretty hot and also above the 2% target for the 26th month. I mean, you would think that you're in a place now where the BOJ can normalize, and that could help the currency.
Well, that is where the pivot comes in. And I think the BOJ will still be inclined to keep policy accommodative at this point in time. And that is also having a positive impact on Japanese equities. So I would think that the yen's strength or recovery will will manifest when foreign investors are actually increasing their allocation into Japanese assets and Japanese equities. And not just that, I think we need the local confidence coming out of 3 decades of deflation to adjust to that structurally. And we see a boost in consumer spending and corporate investments and business confidence. That will create a tailwind for earnings, for consumer spending, and at the end of it, I think the yen strength will be a derivative of all that.
So Brian started by mentioning this trend in artificial intelligence. It's the semiconductor story. We know well what's happening with NVIDIA, what has happened. How do you see the AI story playing out in Japan right now, particularly among the chip makers there?
Well, things that are, I think, earnings expectations have been very strong. And I think a large part of that has contributed, and a large part of the positive surprise on earnings expectations, that whether or not that will sustain, I think that now is getting questionable. But I think the digital transformation is definitely happening. So if we look beyond just the Magnificent Seven, there are companies that, will classify them as productivity enablers, will classify them as enterprise tech. So companies that are having a long runway in this technology and digital transformation journey. And we think that there's still value in those companies and, a lot of opportunities in that space.
Yeah. I started off by asking about the macro because I wanted to see what you felt about generally global growth, and you did actually in your first answer there get to U.S. equities where you talked about quality. And the reason I bring it up now is because you've just been talking about AI. Actually, those Mag 7 companies are sort of in that quality area, right? Because you're talking about strong earnings, upward push in earnings, good balance sheets, plenty of cash on hand. So it's a dilemma. That's where the quality is. You say go for quality. Do you want to go for them?
Well, if you look at the S&P 500, there's 500 stocks that probably over 100 of them are trading at 10 to 40% below their 52 weeks average. So I think broadly, tech is such a broad term, but if you look at our earnings expectations from our latest global investment management survey, is that we are pretty realistic in expecting earnings to be around 7.47 to 8% for this year, whereas markets probably over optimistic.
Okay, Christy, thank you for joining us. Christy Tan, Asia Pacific investment strategist, Franklin Templeton Institute. Selena Ling, Chief Economist and Head of Global Markets Research and Strategy at OCBC. Well, it's very interesting a line here in your notes. You say that financial markets are still calling the Fed's bluff. Explain.
Okay, basically, you've seen from the dots plot, the Fed has gone from earlier pricing in, 3 cuts this year to just 1 cut. But if you look at the Fed funds futures, they're still basically pricing in 2 cuts starting from around September. And our house view also remains that, 2 cuts are likely this year, mainly because we see economic data actually softening. So if you look at the April and March inflation data, so whether it's called PCE deflator or the CPI or the PPI, they have been softening in recent prints. And we also did get a fairly weak retail sales number. So that does suggest that the window is actually opening up for the Fed to cut rates. And although they have only, put in 1 cut this year, But generally, if you look out at their dots plot for 2025 and 2026, cumulatively, they're still looking at 4 cuts per year. So in total, you're still looking at 225 basis points. That means no change in the total amount of cuts that the Fed is seeing over, the 2+ year horizon. So although they have pushed back the timing, but generally, market thinks that, it'll come probably sooner rather than later.
Selena, when you look at the rate of change in the data and how it's softening, do you think there's some urgency now that the Fed needs to pay attention to if it wants to be successful in engineering a soft landing?
I don't think that the data suggests that there is an urgency for them to move. I think, if anything, basically they are just keeping the option on the table, but they are very much data dependent. So if you recall earlier this year in the first quarter, we basically had a string of fairly strong data, both from the labor market side and also on the inflation side, which is why they had, postponed the timing of the rate cuts. I think we'll probably need another 1 to, possibly 3 months worth of softer data before they feel the urgency to cut rates. So we're kind of like in a holding pattern right now, and it is reflected in the Treasury bond market performance.
I know the macro is very important, and everybody is curious about when we might see rate cuts. But up until very recently, until the end of the earnings season, the earnings were really kind of driving the bus. And AI was a big part of that. And we saw a little bit of a sell-off today in NVIDIA and Broadcom, down more than 3.5% for each of them, and the NASDAQ 100 was down. And I made the point earlier just that the market is finding ways to let a little bit of steam out of the marketplace without causing a broad sell-off. Do you see a broad sell-off coming and some sort of correction, or do you think we continue to just sort of take 2 steps forward and 1 step back?
I would lean towards the 2 steps forward and 1 step back. I mean, risk appetite and market sentiments have been very resilient for the year to date. And a lot of that is predicated, first on the story that we're getting a global soft landing narrative taking root. And then secondly, that rate cuts are still on the horizon, at least for the Fed. And in fact, we just had the SMB cut for the second meeting in a row. So apart from that, we also had the Bank of England recently, even though they kept rates unchanged, but I think the signals going ahead is fairly dovish. So market is trying to angle for August cut. So I think the expectations is that the global monetary policy easing cycle will start, probably in fits and starts, depending on which bank you're talking about. But essentially, it's on the horizon.
I'm sorry about that, Selena. A short while ago, we learned that core consumer prices in Japan rose in May at an annual rate of around 2.5%. I think this brings into sharp focus the need for the BOJ to act maybe as soon as July. Do you think that's likely?
Well, the BOJ has been quite clear about the policy normalization path. So they've already started on the initial rate hike. I think going forward, the market expectations and the market pressure obviously is there because of the yield differential story against the US. I mean, just look at where dollar yen is trading right now. So I think the house view really is that they will probably continue to hike rates. In fact, we see at least another 20 basis points minimally on rate hikes on the near term. So it is very likely that as long as the inflation data remains supportive, they will probably want to narrow the yield differential with the rest of the world.
I'm interested in your thoughts of the U.S. adding Japan to the monitoring list for FX practice. It did stop short of calling Japan a currency manipulator. But for somebody who doesn't really watch the FX markets really closely, they might be a little curious as to what sort of practice they would be unhappy with, because you've had this very gradual weakening, but then you also hear that the BOJ wants to kind of come in perhaps, or not the BOJ, but the Ministry of Finance might come in around 160 or so. So are they intervening to the long or to the short side for the yen?
Well, I mean, if you look at the Treasury Department's FX monitoring report, I would say that over the years, the amount of importance that the financial markets have attached to it have kind of subsided a little bit. So while there is interest on who is on the list and for what reasons, I think effectively there is no real economic impact in the sense that there is no real measures that will be undertaken against some of these countries. But it's really very much a medium term, we are looking at you kind of a policy angle. So I suspect that, you may have some knee-jerk reactions in the short term, but over the longer term, short of falling into the currency manipulator list, apart from that, I think there would be very, very little actual, real implications. That's not to say that there won't be pressure, I think, on the Japanese policymakers, to try and rein in some of the excessive moves in the short term. But I mean, if you look at what is happening to the yen, a lot of it is just simply due to yield differentials.
Yeah.
They are starting from a very, very low interest rate base when the rest of the world have been on this aggressive rate hike cycle over the last couple of years. And they are actually trying to normalize policy, although it's very much baby steps at the moment.
Yeah, King dollar too, given those yields, right? Before we let you go, Selena, let's talk a little bit about what you're seeing in China. Yesterday, the loan prime rates, both the 1 year and the 5 year, left unchanged. Do you think that was a prudent move? Does China need to see maybe easier credit conditions still?
I think China has a lot of cards on the table right now, a lot of challenges, whether it's the housing market or the credit market, etc. It's not a surprise that they kept the loan prime rates unchanged, but I think the general policy signals is that they are still trying to provide holistic support to the Chinese economy. I think near term, the pressure will still be on the renminbi, mainly because of the current interest rate differentials, which obviously favor King dollar. As long as the Fed remains reluctant to cut rates soon, Chinese interest rates also look fairly modest compared to the US. So for now, the current stability that we see in the renminbi basically reflects the Chinese central bank's preference for FX stability. But that also means that the renminbi may actually join the Japanese yen as a funding currency if we see this situation persisting. So whether they want to prioritize exchange rate stability or deflation, I think that's the key challenge dilemma going ahead.
Selena, thanks very much for joining us here on the program. Selena Ling, Chief Economist and Head of Global Markets Research and Strategy. A lot of hats there at OCBC. We take a closer look at markets now with Mary Nicola, Bloomberg M-LIV strategist, with us in our Singapore studios. Mary, it's been an interesting year in equity markets so far, but a tale of two quarters. In the first quarter, it paid to be diversified. You not only had gains in technology, but you had a notable broadening in the market, industrials and materials and other sectors doing pretty well. In Q2, it's been mainly the AI breadwinners, companies like NVIDIA and TSMC and ASML and Broadcom. But the gains have been so dramatic that one thinks that perhaps now, we might be ripe for another broadening. I don't know if you see it that way, but how are you looking at markets and the trends at the moment?
Yeah, I think also we're approaching into quarter end, so you could see a little bit of profit taking to come through, especially because it looks like there's been a little bit of frothiness in the market. So of course, people are going to want to lock in some of those gains. So I think it's hard to really consider what the trend is from now to month end, and really how we head into and the start of Q3 will be absolutely crucial in terms of saying where is the trajectory. But so far, it looks like there's still a strong tailwind for equities.
It's first day of summer in the Northern Hemisphere today, Thursday. I'm looking at the foreign exchange market and I'm thinking, where do I want to go on vacation? Is it Europe or is it Japan? I mean, it's unbelievable. Right now, we're talking about a yen that's flirting with 160. How problematic is this for the BOJ right now? Do you think there's a sense of urgency in Japan that they've got to do something?
I mean, with King Dollar, you do have a litany of choices, whether you pick the yen or the euro. So it's on your side. But at the same time, the BOJ is still backed into a corner because at the end of the day, the dollar is going to remain strong. The U.S. Fed officials continue to double down on the fact that they're going to be patient when it comes to the easing cycle. That doesn't put the BOJ that puts the BOJ in a difficult position, especially since their recent meeting, they just kicked the tightening cycle down the road, leaving investors very disappointed in the fact that they didn't announce anything on the tightening of the balance sheet. So obviously you're going to see a move higher towards 160, and that doesn't look unreasonable at the way the dollar strength is going. So the pressure is still going to be on the yen, but this time this volatility is a little bit subdued, which suggests that there is no real urgency for them to step in.
I've drawn some comparisons between the BOJ and the Fed in that they're both pretty conservative, it seems, and the BOJ is conservative from the aspect that it wants to normalize, but it's just finding it difficult to really pull the trigger. And going the other direction for the Fed, it wants to cut, but it's just sort of stuck in neutral. Which of the two do you see moving first?
Well, it's all about inflation, right? And it's all about the sustainability of inflation. One wants to see inflation sustainably above 2%, and for Japan, and for the US, they want to see inflation declining towards that 2% target. So there is that dichotomy where one is dealing with high inflation and wants to see a persistent move towards their target. So essentially, it will come down to Japan will have to start normalizing. I think especially because they're moving towards 2%. Yes, if you look at core inflation, which is inflation ex food and energy, it was around 2%. It was just above 2.1%. It doesn't bode well when it's looking like it's slipping. But at the end of the day, you're still near that target, which suggests that you should start taking your foot off that accelerator that you've had on for so long. So my guess would be that Japan would have to start first.
We just heard a conversation that the team on Bloomberg Surveillance had with Torsten Slok of Apollo, and he's not expecting any Fed rate cuts this year. Do you think that's a possibility? I mean, that growth remains so strong that there's no reason for the Fed to consider lowering interest rates?
At the rate that a lot of the data is showing, it doesn't suggest that there's an urgency. At the same time, if you look at some financial conditions index, financial conditions are loose enough that it doesn't warrant that urgency for the Fed to cut. So there's a little bit of both. And of course, you're seeing some pockets of weakness with the U.S. economy. And of course, that's to be expected because of obviously there's going to be some effect that's coming through from higher for longer. But you're also seeing the resilience of the U.S. economy, especially in comparison to other parts of the world, whether it's the Eurozone or the UK. It's still that the U.S. is holding up relatively well, which also it doesn't bode well for the Fed to start cutting and then having to reverse, especially when we saw already that the inflation trajectory was actually heading lower and then it came back up. So they do want to see that inflation is heading in the right direction before they start easing.
Is there a trend you see in markets that's not getting too much attention but that you find interesting?
Oh, I think the key thing that especially in this part of the world, is just what's happening with the CNY. Obviously, it's getting more attention when there's more things happening with the CNY, but we're going to see that continued drift in CNY weakness, and that's going to be ongoing, likely because of the fact that there is that rate differential that's going to continue to weigh on the yuan, but also on the premise of they still need a weaker currency to support their economy.
Yeah, just not too weak, which is something that comes up a lot because they are waiting really probably for the Fed to cut interest rates before they can do more on the interest rate front. Mary, thanks for joining us. Mary Nicola, Bloomberg M-LIV strategist.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.